Welcome to the Deep Dive. Today we're digging into the Q2 2025 earnings call from Waste Connections, Inc. It's a really interesting one because, well, they seem to keep delivering strong results even when the economy feels, kind of flat.
Right. Flat to negative is how they put it.
Exactly. So the big question for our deep dive today is, how are they doing it? What's their secret sauce for not just getting by, but actually thriving with these headwinds? We're going to unpack their performance, look at the strategy, and see what they're forecasting.
Okay, let's jump straight in with the headline numbers. Waste Connections reported Q2 revenue of $2.407 billion.
Okay.
That's up 7.1% year over year. And impressively, it actually beat the high end of their own outlook.
Nice.
And their adjusted EBITDA, that key profit measure, came in to $786.4 million. Also strong, up 7.5% year over year, and again, slightly above their high-end guidance.
And the margin.
That resulted in a pretty healthy adjusted EBITDA margin of 32.7%.
So definitely strong results on the face of it, especially given, well, some headwinds we'll get into. What really stands out to me, though, is the free cash flow.
Oh yeah, that was robust.
$699 million generated year to date. That puts them solidly on track for their full year target of $1.3 billion. But here's the interesting part. They maintained their full year 2025 outlook. Revenue around $9.45 billion, adjusted EBITDA about $3.12 billion, or 33%. And management specifically called holding that guidance a prudent and a win.
Right, which kind of tells you.
It tells you that if things were, let's say, a bit more normal out there, that strong first half probably would have meant a guidance raise. So there's real underlying strength.
Exactly. It's not just hitting targets, it's beating them in a tough environment and still being cautious.
Okay, so the numbers look good, but the how is always the key, right? How did Waste Connections manage this, especially with those headwinds we mentioned? What's the core operational story?
Well, what's fascinating is the strength coming right from their core business. Solid waste pricing was really strong, 6.6%.
Okay, 6.6.
Yeah, and that comfortably beat their own cost inflation. It drove 70 basis points, so 0.7 percentage points of underlying adjusted EBITDA margin expansion just in solid waste.
But what about volumes? Pricing is one thing.
Right. The flip side is volumes were down 2.6%. But, that's not necessarily bad news here. It seems to reflect a very purposeful price-volume trade-off.
Choosing profitability.
Exactly.
Yeah.
And shedding some underperforming contracts. Think quality over quantity. Plus, we also heard about continued softness in roll-off pulls.
The construction dumpsters.
Yeah, those temporary ones. And also lower disposal volumes, mainly from that construction-type activity, C&D waste. That definitely showed some moderation during the quarter.
So it really sounds like operational execution was just, critical. You mentioned underlying strength. Can we get more specific? What were the drivers, the internal factors?
Absolutely. A huge piece of this was continued systematic improvement in employee retention and safety. And this isn't just fluff. It's a direct profit driver for them.
In a service business, makes sense.
Totally. It's their 11th consecutive quarter seeing voluntary turnover improve. It's now below 11%.
Wow.
Which is down almost 60% from mid-2022. And get this. For the first time in a while, voluntary turnover people choosing to leave is actually lower than involuntary turnover.
That says a lot about the workplace culture, potentially.
It really does.
Right.
And safety results, which usually go hand in hand with retention, hit new record lows again. Incident rates down 15% year over year.
Okay.
Management was explicit. These improvements are flowing right to the margin. They figure 60 to 70 basis points of that 100-plus basis point opportunity they identified is already banked.
Just from focusing on their people, that's significant.
Yeah. Risk management costs are still a bit of a headwind, but even those are getting better.
It's remarkable, really, how focusing on human capital pays off so directly. Okay, beyond the nuts and bolts of operations, what about the bigger strategic picture? M&A, capital allocation, where are they putting their resources?
Right, connecting to the bigger picture. Well, they've had a really outsized year for acquisition so far.
Oh, yeah.
They've already closed about $200 million in annualized revenue just this year, and we're only halfway through.
Wow, okay.
And the pipeline looks strong, too. Another $100 to $200 million in deals are already undersigned LOIs, letters of intent.
So preliminary agreements.
Exactly. Expected to close later this year or maybe early 2026. These are mostly your traditional solid waste tuck-ins.
And the margins on those?
Typically coming in around 25% to 30% EBITDA margin initially. Now, that's a bit lower than the company average, so it's nominally dilutive at first.
Dilutive by maybe 10, 15 basis points, they said?
Yeah, something like that. But strategically, the idea is they integrate them, improve them, and it adds to long-term growth and margin expansion.
Makes sense. And what about returning capital? Balancing that growth with shareholder returns?
They've been pretty active there too. Opportunistic share buybacks, they bought back 1.3 million shares.
Okay.
That's about 0.5% of their outstanding shares, totaling over $240 million year to date.
So they have the firepower for both M&A and buybacks.
Absolutely. Yeah. Management stressed their financial flexibility. Leverage is manageable, but 2.69 times debt to EBITDA, even with all that M&A spending.
Barely moved.
Right. And they also signaled another dividend increase is likely coming after their review in October. Shows confidence.
Okay, so we've covered the impressive wins, the strategic moves. Let's flip the coin. What about those incremental headwinds they talked about? What's actually pushing against the business right now?
Well, the main headwinds are coming from lower contributions from their higher margin commodity-linked businesses.
Like recycling.
Exactly. Recycled commodity values dropped another 10-15% in Q2. And renewable energy credits, RECs, those stepped down about 15% too.
Okay. Ouch. Anything else?
Yeah. Their U.S. oil and gas-related waste business was also down about 10% year over year. Seemed particularly weak in June, tied to crude oil price swings and some policy changes. Interestingly, though, their Canadian E&P waste business, which is more tied to actual production, not drilling, that was actually up year over year.
So that kind of validates their strategy shift there.
It seems to, yeah. Overall, those commodity-driven revenues were a drag of about 60 basis points on margin in the quarter, plus the Chiquita Canyon impact.
Right, Chiquita Canyon. What's the latest development there? That's been an ongoing issue.
So on Chiquita, they said no change to their expectations for cash flow or other financial impacts. The big news, though, is the U.S. EPA stepping in to take a more active leadership role in the regulatory oversight.
And Waste Connections asked for that.
They did, yeah. Apparently, they were dealing with something like 12 or 13 different state and local agencies in California.
Wow, that sounds chaotic.
Yeah, potentially uncoordinated, maybe conflicting objectives. So management's view is that getting the EPA involved with their deeper expertise in these elevated temperature landfills, these ETLFs.
The ones with the internal heat issues.
Right. They think the EPA can bring an adult in the room, was the phrase used.
Ha, okay. Bit blunt.
Maybe. But the idea is it'll streamline things, make it more efficient, and ultimately less costly. Especially since leachate treatment dealing with the liquid runoff is like 70% of the site's costs.
So it's a bet on federal expertise over fragmented local regulation. Interesting gamble.
It is. We'll see how it plays out.
Okay, looking beyond just this quarter then, how is Waste Connections setting itself up for the future? Growth, efficiency, especially with technology.
Well, they're definitely reinvesting CapEx into existing sites, looking for organic growth, pushing sustainability projects. But a big focus now is technology, especially AI-driven stuff.
AI and waste management, how?
Across multiple areas, actually. Things like improving customer retention, refining pricing strategies, better forecasting using data analytics.
Okay, makes sense.
They plan to roll these initiatives out more broadly through 2026 and 2027. The goal is more digitization, better customer experience, and ultimately driving efficiency gains to protect those industry-leading margins and that price-cost spread.
Right, that spread is key.
Absolutely. Oh, and they also mentioned pulling forward some fleet and equipment purchases into 2025.
Why is that?
To get ahead of potential tariff-related price hikes they see coming in 2026. Suppliers are apparently warning about maybe 4 or 5% cost increases on trucks then, with 2-3% possibly tied to tariffs. So proactive cost management.
Smart. Okay, so let's bring it all together. What does this mean for you, the listener, maybe tracking this sector or thinking about investments? Waste Connections clearly shows the strength of solid waste, even when the macro picture is murky. But that economic softness, it just seems to linger.
Yeah, and that's a really important point. Management basically said, look, if it wasn't for the uncertainties and those lower commodity prices, the strong first half absolutely would have justified raising the full year guidance.
So the softness is real. Where are they seeing it most?
It's really concentrated in those construction-linked areas we talked about. C&D, tons construction and demolition waste down year over year for 7 straight quarters now, averaging like 7-8% down.
7 quarters, wow.
And roll-off pulls down for 6 quarters, averaging about 3% down. They're not banking on some big economic recovery. They basically said the economy's been flat to negative for almost 3 years if you exclude government spending.
So any pickup there is just pure upside for them.
Exactly. Given their market share and footprint, any improvement in construction or the general economy would flow right through. They're built to thrive despite the current sluggishness.
It really does sound like they're playing great defense, but ready to jump on offense when conditions improve. Okay, last key point. That price-cost spread. How do they plan to keep that favorable margin, especially if inflation keeps coming down?
Right. Historically, they've managed about 150 basis point spread price increase versus CPI, which they use as a proxy for their costs.
Okay.
So as CPI potentially steps down, yeah, their reported price increases will likely moderate too. But they expect to maintain that favorable spread because they actively manage towards it. Plus, their own costs are also coming down overall.
So it's about the gap staying positive.
Precisely. They noted, if CPI settles around 2.53%, they probably need price increases around 5.5% to get the same margin benefit they're getting from 6.5% price now.
Got it.
So the key takeaway for you, the listener, is that the operational discipline, the focus on employees, the tech investments, it's all geared towards making sure that margin expansion can continue, even if the headline numbers shift a bit. It's like having a really well-tuned engine.
All right, now for our This Is Not Financial Advice segment, time for an outrageous but plausible trade idea, fresh from the committee. Based on this Waste Connections call, what's the wild trade?
Okay, based on everything we've heard, here's the pairs trade idea. Long Waste Connections, WCN, short a basket of U.S. construction materials, or maybe some cyclical industrial services.
Okay, long WCN, short construction cyclicals. Explain the thinking.
It's pretty straightforward, actually. Waste Connections just demonstrated again how resilient it is. They beat expectations, held guidance despite clear headwinds from construction volumes and a sluggish economy. Their core solid waste business is humming along strong pricing, those operational gains from retention, smart M&A. It's driving margin expansion from within.
Well, the short side.
Meanwhile, the sectors we'd short construction materials, maybe some industrial services heavily tied to new builds or cyclical activity, are directly exposed to that very softness WCN is navigating but offsetting. C&D tons, roll-off pulls, down for multiple quarters, no clear rebound signaled.
So you're betting on WCN's defensive quality and operational strength against sectors directly hit by the slow economy.
Exactly. It's a bet that strategic waste management, with its pricing power and internal improvements, outperforms those highly cyclical plays, especially if we stay in this kind of flat to negative GDP environment.
Yeah.
Capitalizing on WCN's ability to manage its own destiny versus sectors more reliant on the macro tide lifting them.
That's a wrap then on our deep dive into Waste Connections Q2 2025 earnings. What we heard today really underscores their strong operational game, smart capital use, and how they proactively handle challenges. Really reinforces the resilience you can find in essential services.
Indeed. That focus on people, bringing in tech like AI, strategic deals, it positions them well. It's a great case study, really, in finding growth and efficiency, even when the broader economy isn't exactly helping out.
And that leaves us with a final thought for you to chew on. Is Waste Connections' ability to perform so well despite economic sluggishness, falling commodity prices, and tricky regulations like Chiquita Canyon? Is that signaling a new normal where well-run essential service companies are just inherently more stable? Or is it really down to their specific playbook, the operational discipline, the M&A strategy, something unique that maybe others can't easily copy?
Something to think about. And as always, remember this discussion is just for informational purposes. It definitely does not constitute financial advice.
Thank you for tuning in to the deep dive. We appreciate your time and hope you continue your own exploration of these insights.